In this video, I am going to discuss about costing. Costing is also known as the cost accounting. Costing is the process of estimating and determining the total expenses or costs involved in producing a product or providing a service. It is a crucial aspect of management accounting that helps organizations make informed decisions about pricing, budgeting, and profitability. Why costing is important? Pricing decisions. Costing helps organizations determine the true cost of producing a product or delivering a service. This information is crucial for setting the price of the product or service that covers all the costs incurred and generates a profit. Budgeting. Costing provides a basis for preparing budgets by estimating the cost of raw materials, labor, and overheads required to produce a product or service. This information used to plan and allocate resources effectively. Profitability analysis. Costing is crucial when it comes to determine the profits for goods and services. In order to set a profit markup or margin, the costing is really important. Cost control. Costing enables organizations to monitor and control their expenses by identifying areas where costs can be reduced without affecting the quality of the product or service. This helps organizations maximize their profits and improve their competitiveness. Performance evaluation. Costing provides information that can be used to evaluate the performance of different departments or product lines. By comparing actual costs to budgeted costs, organizations can identify areas where performance can be improved and take corrective actions. Investment decisions. Costing helps organizations evaluate the feasibility of new projects or investments by estimating the costs involved and the potential returns. This information is critical for making sound investment decisions that generate a positive return on investment. Now let's discuss about the differences between cost accounting and financial accounting. Purpose. The primary purpose of cost accounting is to provide information about the cost of producing goods and services, whereas the primary purpose of financial accounting is to provide information about the financial performance and position of the organization as a whole. Users. Cost accounting is primarily used by internal stakeholders such as managers and employees, whereas financial accounting is primarily used by external stakeholders such as investors, creditors, and regulators. Time frame. Cost accounting focuses on the current and future costs of production, whereas financial accounting focuses on past performance and historical data. Scope. Cost accounting is more focused and specific, analyzing the costs of individual products, departments, or activities, whereas financial accounting is broader, covering the entire organization's financial performance. Standards. Cost accounting has more flexibility in terms of accounting methods and standards, whereas financial accounting follows strict accounting standards and guidelines, such as GAAP, Generally Accepted Accounting Principles, or IFRS, International Financial Reporting Standards. We will discuss about these two guidelines and standards under financial pillar in CIMA. Reports. Cost accounting generates reports such as cost sheets, job cost reports, and variance analysis reports, whereas financial accounting generates reports such as balance sheets, income statements, and cash flow statements. These differences you can read and understand very easily. Inventory costs are directly related to the production or purchase of goods for resale and are capitalized and allocated to the cost of goods sold when the goods are sold. These are the most common inventory costs: direct materials, direct labor, manufacturing overhead. These are also known as the production costs. Any cost that will be incurred under production will be considered as inventory costs. Period costs are not directly related to the production or purchase of goods and are expensed in the period in which they are incurred, such as rent, salaries, advertising, depreciation, insurance. These are non production costs. We will discuss about each of these costs in greater detail in next videos. Now let's discuss about the importance of management accounting. Decision making. Management accounting provides financial information and analysis that helps managers make informed decisions about pricing, product mix, resource allocation, and investment decisions. Planning and forecasting. Management accounting provides information that helps organizations plan and forecast their financial performance, including budgets and financial forecasts that help organizations plan and make informed decisions. Performance measurement. Management accounting provides information on the performance of the organization, departments, and individuals, which helps in identifying areas for improvement and setting targets. Cost control. Management accounting is concerned with the analysis of costs, including the identification of costs associated with specific products, processes, or activities. This helps organizations to control costs and improve efficiency. Now let's discuss about the differences between management accounting and cost accounting. Earlier we discussed about the differences between cost accounting and financial accounting. Focus. Cost accounting focuses on the measurement, analysis, and reporting of costs associated with products, services, and activities. Management accounting, on the other hand, is focused on providing financial information to support management decision making and planning. Scope. Cost accounting is primarily concerned with the analysis of historical costs, while management accounting takes a broader perspective and considers both historical and future costs and revenues. Audience. Cost accounting information is primarily used by internal stakeholders such as managers and employees involved in the production process. Management accounting information, on the other hand, is used by a wider range of internal stakeholders, including managers, executives, and employees across different functions and departments. Time frame. Cost accounting is focused on the short-term costs associated with the production of goods or services. Management accounting takes a longer-term perspective, looking at the costs and revenues associated with the organization's overall operations and strategic goals. Information sources. Cost accounting relies on data generated from the organization's financial accounting system, such as sales invoices, purchase orders, and production records. Management accounting relies on both financial and non financial data, such as market research, customer feedback, and industry trends. You can read and understand these differences easily. Now we are going to discuss about frequently used management accounting terms such as cost unit, cost object, cost center, cost pool, cost driver, cost card, and cost classification. In order to discuss these terms and understand these terms, let's consider this example. We will use this example throughout these terms. Let's consider the example of a manufacturing company that produces electronic devices. They are producing mobile phones, tablets, and laptops. What is a cost unit? A cost unit is a specific unit of product or service to which costs can be assigned. In our example, a cost unit could be a single electronic device, such as a smartphone, a tablet, or a laptop. These are the cost units: smartphone, a tablet, or a laptop. we can assign costs into these cost units. It is very important to notice that a cost unit can be either a product or a service. Both can be a cost unit. What is a cost object? A cost object is anything for which costs are tracked, analyzed, or allocated. In our example, the cost object could be the entire production process for electronic devices or a specific stage in the production process, such as the assembly line. In management accounting, we can use the cost unit and the cost object interchangeably, but you have to have the clear understanding about what each term means. So, a cost object is anything for which costs are tracked, analyzed, or allocated, which means we can assign costs into these cost objects. What is a cost center? A cost center is a department, function, or area of the organization that incurs costs. In our example, a cost center could be the assembly department, where the electronic devices are put together. What are the departments in an organization? HR, finance, marketing, sales, likewise. What are the functions in an organization? Training, advertising and marketing, sales, likewise. We can consider any department, function, or area of the organization that will be incurred costs as a cost center. There are four cost centers: function, activity, service, location. Let's discuss about these cost centers one by one. Function. A function refers to a broad category of activities or operations within an organization, such as production, marketing, or research and development. Costs associated with a particular function are often aggregated and reported together. Aggregated means adding up all the costs for each function. Activity. An activity is a specific task or process that contributes to the completion of a function. Examples of activities might include assembling a product, conducting market research, or managing inventory. Costs associated with each activity are tracked separately in order to identify areas for improvement. Service. A service refers to a type of support that is provided to other areas of the organization. Examples of services might include accounting, information and technology, or human resources. Costs associated with providing a particular service are typically allocated to the areas of the organization that use that service. Location. Location refers to the physical location where an activity or function is carried out. Costs associated with a particular location may include rent, utilities, and other expenses related to maintaining a physical presence in that location. These are the four types of cost centers. Now let's discuss about what is a cost pool. A cost pool is a collection of costs that are grouped together for a specific purpose. In our early example, a cost pool could be the direct materials used in the production of electronic devices, such as the components that go into making the device. Cost driver. A cost driver is any factor that influences or causes a change in the cost of a cost object, which means this can be any factor that influences the cost to be changed. In our example, a cost driver could be the number of electronic devices produced, as the cost of direct materials and labor will increase with the number of units produced. The number of production units influence the cost of direct materials and labor to increase. So the number of production units is the cost driver. Cost card. A cost card is a document or record that provides a detailed breakdown of the costs associated with a particular product or service. A cost card typically includes information such as the material used, labor costs, overhead costs, and the other expenses incurred during the production process. It may also include the information on the cost of each individual component or task involved in the production process. It may also include information on the cost of each individual component or task involved in the production process. The purpose of a cost card is to provide a detailed and accurate record of the costs associated with a particular product or service. This information can be used to calculate the total cost of production, determine the profitability of the product or service, and identify areas where costs can be reduced or eliminated. These two cost cards are the most common and frequently used cost cards in management accounting. The first cost card is known as the marginal costing cost card. The second one is known as the absorption costing cost card. We will discuss about the marginal costing and the absorption costing in greater detail in next videos. For now, just have an understanding about there are different types of cost cards when it comes to management accounting. So under marginal costing, we only consider the direct variable costs such as direct material, direct labor and variable overhead costs. So we can calculate the cost per unit. Under absorption costing, we consider all the production costs such as direct material, direct labor, variable overhead and fixed overhead. So we can calculate the full cost per unit. This is also known as the full cost. Now let's discuss about the cost classification. In management accounting, we can classify cost into these three categories: by nature, by purpose and function, and by behavior. We will discuss about each of these costs in greater detail in next videos. So now have a basic understanding about these costs. There are three categories under classification of costs by nature: material cost, labor cost, and expenses. Material cost is the cost for raw materials, and the labor cost is the cost for labor. And any cost that cannot be categorized under material or labor cost will be categorized under expenses. All these costs are variable costs, meaning these costs will be changed as the number of production units change. Now we have two categories under cost classification by purpose or function: direct and indirect costs. Direct costs are easily identified for a cost unit, whereas indirect costs cannot be identified for a cost unit. The direct costs are also known as the production costs, and the indirect costs are also known as the non-production costs. These direct and indirect costs can also categorize by nature. So there are direct material, direct labor, and direct expenses. Direct materials are the raw materials for the production. Direct labor are the labor cost for the production. And any cost that is direct but cannot be identified under material or labor can be categorized under direct expenses. We can use the same classification for indirect costs as well: indirect material, indirect labor, indirect expenses. An example for indirect material is lubricant oil for the maintenance of machinery. For indirect labor is the labor cost for maintenance. For indirect expenses, maintenance cost can be considered. All these are non-production costs. We can divide costs under cost classification by behavior again, which are fixed costs, stepped fixed costs, variable costs, and semi-variable costs. Example for fixed cost is rent. Example for stepped fixed cost is purchasing a new machinery. An example for variable cost is direct material. An example for semi-variable cost is electricity bill. We will discuss about each of these costs separately in later videos. Now let's discuss about the cost elements. Cost element refers to a specific type of expense that is incurred by a company as part of its operations. Cost elements are used to classify the various types of expenses that a company incurs, such as direct materials, direct labor, manufacturing overhead, or selling and administrative expenses. Cost elements are typically used in the context of cost accounting, where they are used to allocate costs to specific cost centers or cost objects. And now let's discuss about the costing techniques. These four techniques will be used under management accounting when it comes to costing: marginal costing, absorption costing, activity based costing. This is also known as the ABC, and joint product costing. The first two costing methods, the first two costing techniques, which are marginal and absorption costing techniques, will be frequently used in real life businesses. We will discuss about these costing techniques in greater details in later videos. Thank you for watching. See you in the next video.